Today, we will discuss what benefit we get from discussing the Forex market structure to understand what each person is doing in this market, what their capacity is, what they are capable of, and what their needs are. What are the requirements we have to operate in which market? As we discussed earlier, the Forex is a decentralized market. It is a democracy, not a dictatorship. There is no central exchange for it. How can we determine its rate in that? As you can see, only one bank or one personal rate will decide. Various financial institutions, major banks will send supply and demand to each other. The intermediate market rate that is formed will be determined. The market will move based on that. So we understand that in this environment, the most real influence we have is from major banks. So major banks, the biggest in this are our peer meaning banks, which are large banks. They access this market. In this market, the biggest supply-demand providers and its largest market movers, we have examples of banks like Citibank, JP Morgan, Goldman Sachs, Justice Bank, UBS Bank. In this way, various banks have been coming to us, and the biggest in this hierarchy is also there. EBS. What is EBS? EBS, Electronic Brokerage Services, meaning liquidity provider, meaning counterparty provider. Now, why is it necessary to understand this? Now the bank bought something. Now if they want to sell it, they need a counterparty to sell it to. That is a basic rule. To buy something in the world, you need a seller who is ready to sell that thing. And if you want to sell something, you need a buyer outside who is ready to buy it.
A major bank bought something.
Now, if they want to sell and take their profit, they need a counterparty for that. Now, who provides that counterparty? EBS, Electronic Brokerage Services, provides it. And when they provide a counterparty, basically what they do is determine where the bank wants to take profit, at the top or at the bottom. So at the top, they were given selling and asset, they need buyers. And at the bottom, given buying and asset. If they need it, what will happen? Who will be the counterparty? You or me will be convinced by the help of brokers, by the help of liquidity providers, that, my friend, you should buy this thing, you should sell this thing, for that different methods and different influences and different market movement charts are also used, which make you inclined to think that even something expensive seems cheap to you. For example, gold made a $700 movement from 2000 to 2700. So now buying at 2600 seems cheap to you. The reason is that a concept was created for you. You don't know how it was created. Your subconscious is being worked on. By many influencers, by many banks, and on special charts, such movements are rewarded multiple times by the bank. A concept will form in your mind that this thing is expensive or cheap. For example, just an example, this does not mean that now gold will go down or up. The purpose is to create in your subconscious that something is expensive or cheap. That is the job of liquidity providers. After that, we have medium-sized normal banks. Then we have retail, market makers, retailers, hedge funds, commercial companies. All these move the markets, create their supply and demand. Then at the end of the you have retail traders who do not make anything from market movement. As we read earlier, this is about 9% of the total daily trading volume. We create a volume of $200 to $300 billion by combining all retail traders. and the market's daily trading volume is $7.5 billion. So we have no standing in this market. Now, why am I emphasizing this point? The purpose is not to degrade our sellies. The purpose is to try to understand in trading what the big banks want to do, how they do it, and we need to recognize their moves, identify them ahead of time, and follow the trends they create. We have to follow their wishes. That's all there is in trading, nothing else. Now, the second is margin trading. We discussed, we dragged all things, how marriages work. We discussed all that in margin. Margin is what you have to deposit as a guarantee or security with the bank. That's called deposit margin. If your leverage is 1 to 100 and you have bought one standard lot of Euro USD, then your $1,000 are completely blocked. So your entire margin is blocked. But if, for example, you buy a 0.5 lot, then the requirement for purchasing is 500,000 for you. If your leverage is 1 to 100, then your margin required is in dollars. To place that trade, after placing the trade, you have dollars remaining on which you can make further trades. But if you have opened a standard lot which consists of 100,000 units, what will happen in that? The issue will be that your entire deposit will go into the margin requirement. Regardless of whether you go into profit or loss, until that trade is closed, you cannot place another trade. You have money in the account. Sometimes you are placing a trade and the trade does not get placed because your margin is exhausted.